Welcome to our CFP exam prep discussion, focusing on gifted property basis rules. Today we're diving deep into a commonly tested concept that often trips up exam takers. Let's start with the fundamental principle. When someone receives property as a gift, they generally take over the donor's basis, known as carryover basis. This means if your aunt bought a stock for $10,000 and gifts it to you when it's worth $25,000, your basis remains $10,000. Many candidates mistakenly assume the recipient's basis becomes the fair market value at the time of the gift. However, the exam loves to test the exceptions to this rule, particularly regarding lost property and appreciated property where gift tax is paid. Let's break these down. For lost property, we need to consider dual basis. If the property's fair market value at the time of the gift is less than the donor's basis, we use different bases depending on whether we're calculating gain or loss. When calculating a loss, we use the fair market value at the time of the gift. For gains, we use the donor's original basis. Here's a practical example. Your uncle bought a rental property for $300,000. He gifts it to you when it's worth $250,000. If you later sell it for $320,000, your gain is calculated using the $300,000 basis. However, if you sell it for $240,000, your loss is calculated using the $250,000 basis. The second exception involves appreciated property where gift tax is paid. The basis gets stepped up by a portion of the gift tax paid, but only the gift tax attributable to the net appreciation. The formula is basis plus gift tax times the appreciation ratio. The appreciation ratio is net appreciation divided by the property's value at gift. Many test takers forget this adjustment or miscalculate the appreciation ratio. A common mistake on the exam is failing to recognize when these exceptions apply. Remember, the gift tax paid adjustment only applies to the extent gift tax was actually paid, not just calculated. With the current lifetime exemption being so high, many gifts don't actually result in gift tax payments. Another tricky area is the so-called no gain, no loss zone in lost property scenarios. If property is sold at a price between the donor's basis and the fair market value at gift, neither gain nor loss is recognized. The exam often includes questions designed to test your understanding of this concept. Let's solidify this with a comprehensive example. A donor purchased stock for $50,000. When the stock value dropped to $30,000, she gifted it to her son. Gift tax was not applicable. If the son sells the stock for $60,000, his gain is $10,000 using the donor's $50,000 basis. If he sells for $20,000, his loss is $10,000 using the $30,000 fair market value at gift. If he sells for $40,000, there's no gain or loss because it falls in the no gain, no loss zone. When studying for the exam, focus on recognizing these scenarios and understanding which basis rules apply. Practice calculating basis adjustments for gift tax paid situations, and always watch for circumstances indicating lost property treatment. Remember, the exam writers love to test these exceptions rather than the general carryover basis rule. Keep these distinctions clear in your mind, and you'll be well prepared for any gifted property basis questions on the CFP exam.